Joining me now is Julie Biel, Chief Market Strategist over at Kayne, Anderson, Rudnick. Julie, you are now, I think, the third or fourth guest this week that we've talked to that has pointed out healthcare as a trade. What exactly is attractive to you about it, and where would you be going with it?
I think that the real challenge with the way that the market is set up right now is we have this dependence on everything in AI working out. And I think you also have seen, especially in small cap, this swing towards these non-earners, non-profitable companies. I think balance does a body good, and I think nice earnings sustainability does a body good. Within kind of small and mid-cap, West Pharmaceutical and Merit Medical, these are both businesses that don't have the same kind of pharma risk that you have in, what you would call small cap pharma in terms of there's only one product that you're dependent on. They're much more diversified in their businesses. West in particular has a pretty strong level of market share, and they're benefiting from GLP-1s. But what I think you want overall is just some earnings stability and resilience to add to your portfolio when you have kind of these to-the-moon bets as well.
Earnings resilience and stability seems to point you more towards mid-cap and large-cap healthcare, pharma, bio, that sort of thing. But why stay on the mid-cap side of things?
I think that the valuations in general are a lot more attractive. And I think being able to have some exposure to these smaller businesses that have longer runways in front of them, many of them are also pursuing markets that are smaller, more niche. And so they don't invite as much competition as, say, everything that we've seen in GLP-1s, right? There's just this proliferation of competition. I think when you can be a little bit more niche, you protect yourself and you get to maintain some of that earnings resilience and have a nice runway of growth as well.
How much of that is going to be dependent on the regulatory and macro environment that some of these companies face? We know that some of the big guys, namely Eli Lilly and Novo Nordisk, seem to be cozying up fairly well to the administration. Maybe they have a better runway on that front. But how do small and mid-cap healthcare companies have to navigate what the future could look like with the Trump White House?
You have to be really careful, and I think that's why we prefer to choose names where we don't have the same level of risk in terms of reimbursement and changes in terms of pricing. Most of these businesses are niche, and they're supplying, say, the surgeon with specific tools that they use, and so they don't have the same level of regulatory risk when it comes to pricing. Most of their pricing negotiation happens with the hospitals. In the case of West Pharmaceutical, their products are priced at cents, right? They're small elastomer products on your drug delivery mechanisms, and so they have less pricing risk as well. There's some in terms of the risk of competition, but for them, it's much less about the regulatory overhang, and there's much more visibility on their business than, say, an Eli Lilly.
All right, so the healthcare trade, Julie, is one that we know you're high on, and specifically small and mid-cap. If we could broaden out a little bit to the price action that we've been seeing this week, we are now not that far away from record highs, but the noticeable pullback in tech and artificial intelligence specifically has some investors and traders worried about a possible change in trend. Do you feel as though this is a medium-term and even longer-term top?
Yeah, I think it's always hard to call a top, right? But I do think that the concerns are really valid because on the one hand, you have so many reports coming out and talking about AI and how most of the pilot projects have not been successful as enterprises tried to integrate them. We know they'll continue to get better. And I do think that the long-term fundamentals of AI are great. It's just a function of what the timing looks like and then what the economic models look like. I think what's really spooked investors is this recognition that initially everyone felt great because all of this investment was being funded out of cash flows, and now it's being funded by debt. And I think, hearing about Meta's very, very careful off-balance sheet financing and hearing that OpenAI is looking for a backstop on their debt, I'm sorry, but that's not how capitalism works. You can't go to daddy. This isn't like going to daddy and expecting him to backstop, your new home purchase. That's just not how this works.